Okay, so here we are again with some journal entries under the perpetual inventory system. We're going to do purchases and sales. We're going to do both sides here in these transactions that we're going to work on in this worksheet. So let's get right into it. Archer Spy Supplies, they use the perpetual inventory system. Journalize the following transactions for the spy shop. Explanations are not required. So again, as a reminder, we've done this a few times now, journal entries. We know that we always do an explanation for our journal entry at the last line. So in the real world, you're going to do an explanation for what your journal entry is all about. But now that we've done that practice so many times, we don't have to worry about it for the homework's case. And so we're just going to worry about our accounts that we're debiting and crediting. But normally in the real world, you're going to do an explanation. All right, let's get right into this. We have February 3rd. So I don't know, we'll just write 2-3, easy for me, but you probably spell out February 3rd in your homework. But anyway, we purchased 3,300 of merchandise inventory on account under terms 310 and EOM and FOB shipping point from J Bond Company. All right, so if we pay for this inventory within um, 10 days, we'll get a 3% discount. If not, it's due at the end of the month. That's the EOM. That means end of the month. So if we don't pay within the 10 days, you don't get that 3% discount, and the full amount is due at the end of the month. Okay. So let's first do our journal entry for that merchandise inventory that we got. So we got merchandise inventory for the value of 3,300. All right, and then we didn't pay it cash out, so we have accounts payable then as well for the 3,300. And probably by now they want you to identify whose the accounts payable is. Well, it's going to J Bond Company. There we go. All right, so that's it for that one. Now we have on February 7th, they returned $900 of defective merchandise that was purchased on February 3rd. So part of that February 3rd's purchases, $900 was returned back, no longer owe it. So we're going to decrease our accounts payable to J Bond for 900, and we no longer have that merchandise because we sent it back. So we're going to decrease merchandise. Oh, there we go. Okay, not too bad so far. All right, next we have is on February 9th, they paid a freight bill for $400 related to that February 3rd purchase. So it's not saying on account or anything. So we're just going to assume that we paid $400 of cash for that freight, for that delivery of that merchandise. So that $400 is an additional cost uh, for our merchandise inventory. So our merchandise inventory cost value goes up by the $400 for that freight. So we increase merchandise inventory by the $400. We'll do a debit. I've always typed too fast for the keyboard. There we go. 400. And then I said we assume we paid out cash. It doesn't say on account or anything. So we paid cash for that. So decrease our cash by 400 bucks. Not too bad so far. Just the one key thing to remember them is that it adds that freight bill, that freight cost adds to the value or the cost of our inventory. So that's why we increased inventory by $400. All right, so that was it for purchases. Now we're getting into sales. So here we are, February 10th. We sold, Archer sold merchandise inventory on account for $4,700 to Mallory Spy Services. And the payment terms were 215 and 30. So if Mallory Spy Services pays within 15 days, they get a discount of 2%. If they don't pay within the 15 days, then the net amount is due in 30 days. Okay. So they want us to begin by preparing the entry to journalize the sales portion of the transactions, to record the expense related to the sale. We'll do that in the next step. So we have two parts. Oh, here we go. Two parts related to this journal entry. We're going to record the sale portion, and then we'll record the cost of that merchandise portion. So we'll have two separate journal entries that we need to do. So the first journal entry they want us to do is the sale portion, and this is the order that it always goes in. All right. So we didn't get cash right away from Mallory Spy Services. They said put it on my account. I'll pay you later. Okay. And so we're doing our perpetual inventory system here, and we're going to follow our rules under GAAP. And so we are going to, we want to be conservative. We don't want to overstate our sales revenue. We want to be more conservative. So we're going to assume that Mallory Spy Services is going to take that discount. All right. So we don't know if they're going to take it or not, but to be on the conservative side, so we don't overstate our revenue. This is our rule for our GAAP. Following GAAP, our revenue recognition standards. That's what this is called. And after this video is done, I'll write it in the worksheet out a little bit for you as well. So we can't record the full amount since there's a discount offered, and that's our revenue recognition standards. So we're going to assume the customer will pay in time for the discount. And so when we do our journal entry, we're going to record under that assumption. So, and again, like I said, this was a conservative approach, so we don't overstate revenue. Okay, so we don't get to record revenue for the full 4,700. We have to assume they're taking the discount. All right, that's a 2% discount. So let's get to writing out our calculation here. So we have 4,000. Oh, that's okay. We can use that amount. That pen kind of bright, but that's okay. And we're going to get a 2%. We're going to assume they're going to take that 2% discount. Okay. And so that would be $94. That's our discount amount. So we're going to assume that they're only going to pay that amount less than $94, which is $4,606. All right. So we want to be conservative. I'm going to assume they're going to actually end up later on pay that $4,606. So our sales, not for 4,700, is for 4,606. All right. We'll talk about what happens if they don't take the discount later. But we have to assume under our being conservative under our revenue recognition standards this. So February 10th, we're going to assume we're going to receive from them the discounted amount instead. So we have accounts receivable, and it was Mallory's Spy Services, and it's going to be the 4,606 that we calculated. That's with that discount, and that is the whole reason our sales revenue for the amount that would have been the discount amount. All right, cool. Now we do the other half. So the other half now is to record the cost of that merchandise. So we sold merchandise, so this merchandise is gone off our shelves, off Archer's Spies shops shelves. So they got to record that merchandise has left, and we're going to record an expense for that merchandise, which is our cost of goods sold. And so I said it was an expense. We know under Dead Curls, expenses are a debit balance, so cost of goods sold will be a debit balance as well. And they told us the amount. They wrote cost of goods is $2,350. So that was nice of them to give us the amount. We don't have to calculate it yet. That is February 10th as well. Sometimes you see it as, I'll just do this so you're not confused. So you might see COGS quickly written as well. That's the abbreviation, or cost of goods sold. And they told us 2350. Perfect. And this inventory is gone. It's no longer there. So we will decrease our inventory, our asset, by that amount, by the cost. That was our cost of inventory. That's the inventory that's gone. That's why we decrease it with the credit. And then we want to have a match of an expense related to that revenue. Well, this is our expense or cost, debit balance, related to this revenue, right? The credit balance. Perfect. All right, so now we are done with that journal entry, and we have now February 12th. Let's just move this over slightly because it's off-centered and it's bothering me. All right, perfect. So what we have next, we had paid amount owed on credit purchase of February 3rd, less return and discounts. That was nice of them because they reminded us again, don't forget about the discount, but you should always check your dates and see if February 12th with February 3rd was within that discount period, to see if they get that discount or not. All right, and also they tell us don't forget about the returns that were as well done. So this was the pay. This is now being the payment for the purchases done on February 3rd. So if we scroll back up here, you can see the start of our purchases for February 3rd, right? For our equipment that we purchased. And so let's do a T account to reconcile this. And so that way we could do our journal entries. So let's go all the way and give us some space. I'm going to give us some extra space here. All right, so that way we have it in line with what we're doing. And let's go ahead and get this drawing pen. Make it slightly smaller there because it was too thick to me. All right, so this is our accounts payable that we owed to J Bond, I believe. All right, so that's our T account for that accounts payable for the February 3rd. And we had purchased 3,300. So we went all the way back up. Yep, there's our J Bond Company, 3,300. All right, that was 2-3. And then on February 7th, I think there was a return or something. Let's see. Oh, here we are. Oh, you can see I wrote the wrong date there. Let's correct that. So on February 7th, okay, there was a return for $900 worth of inventory. So we have a credit for inventory, a debit, excuse me, for our accounts payable. And that was February 7th. All right. And so our balance of what we owe right now is 3,300 minus 900, 2,400. That 2 will erase. All right, that's the balance due. There we go. We'll write a little neater there. All right, so let's pay attention to our dates. We're looking at February 12th. Scroll up a little bit. February 12th to the 3rd, and it was credit terms were 310. Oh, so 3% discount paid within 10 days. Were we paying within 10 days? Yes, we were. Just made it. Just made it. So they get a 3% discount. So let's go ahead and calculate that. And I'll tell you what that is. That's 72. All right, so our discount rate was 3%. And so really what's going to be paid in cash is going to be less by $72. And so that is $2,328. All right. Okay, so let's go ahead and record this journal entry. So we're gonna go ahead and get rid of the full balance of that accounts payable. Right now it's sitting there at $2,400 as a credit. And we want to say, well, we're paying it now, so we no longer owe this amount to J-Bond. Yeah, we're going to pay less than that amount because we get a discount, but we got to wipe out the full, so we're not saying that we owe this full amount. So we're going to debit for $2,400 to zero out that T account there. All right, and then we have cash of $2,328 being paid. All right, and so we're out of balance. That is our $72 discount, and I said that in previous video that our discount decreases our inventory's value. Inventory is a debit balance, and so we need a credit balance to decrease it for that discount taken. So we're going to decrease merchandise inventory's value by that discount amount. The cost of the inventory is now less by $72. Let's do some spaces there so it looks more even. Perfect. So if we added up our two credits there, and they would equal our debit. We're good with February 12th amount. So let's go ahead and keep going. Now let's do February 28th. So on February 28th, they received cash. Let's move that up a little bit so we have room for some T's that we maybe need to do our calculations. So we received cash from Mallory Spice Services in full settlement of their debt. So that was February 28th. Oh, and what was our credit terms? So they're saying the full amounts. That was nice of them to tell us, but we should double check still. And so that sale was on February 10th, and if it was paid within 15 days, they would have gotten the discount. Well, we assumed that they were going to take the discount, but here you go. They didn't get the discount. They didn't pay within that 15 days. And so how are we going to reflect that? Because we already recorded our receivable and our sales revenue by the 4,606. That's okay. We'll have another form of revenue that we'll get to record for this difference, for that $94 that wasn't taken as a discount for because Mallory Spice Services paid past that 15 days mark for that discount. So don't worry, we're going to get to that. So we'll have a discount that Mallory forfeited. And so let's go ahead and get started here. So February 28th we have, and they're paying the full amount. They didn't take the discount, the full settlement of their debt. So really the full amount was $4,700. See up there? Okay. So we're getting all of the cash. They didn't take a discount, so they owed us the full amount of $4,700. And then we recorded accounts receivable, assuming they were going to take that discount. What was this, Mallory? Taking a little delay there. All right. And that was with the discount was 4,606. So we see this debit. We're now going to credit it because we're no longer looking for that from them for 4,606. All right, we're not in balance. We need a credit. Well, the credit is the discount that was forfeited. So we have a forfeited discount for 94 bucks. We had previously calculated that. I don't know why there's a delay here, but we're almost done so we can get through this. And so our credit is now a type of revenue account. We're not going to do sales revenue. Instead, we want to categorize this to keep track of the discounts that were forfeited. So just as it sounds, sales, discount, forfeited. So that is our new type of revenue account that we have. And there we go. We are in balance. So again, you can see that on 210, the journal entries amount recorded was with the assumption that they're going to pay within the discount period. And in this case, they did not pay within the discount period. So we instead collected the full amount of the cash. We're going to still decrease our receivables account that we had originally recorded, assuming they were going to take the discount. And so, yeah, we're not in balance. We need a credit for that discount portion, and that will go to sales discount forfeited. All right. So that is it for this problem. It's just all about practice of getting used to it for these type of journal entries that we do under the perpetual inventory system.